Welcome back to the Deep Dive. Today, we're jumping straight into JD.com, the Chinese e-commerce giant. Their latest numbers just dropped, Q2 2025, and there's a lot to unpack. We're going beyond the headlines, looking at what these figures really mean for them.
Yeah, it's a really interesting set of results because on one hand, you've got this really quite impressive top-line growth. Revenue jumped 22.4% year over year. That's RMB 356.7 billion or about US $49.8 billion. And that easily beat what analysts were expecting, which was around RMB 335 billion.
Okay, 22.4% growth. That's strong, especially accelerating from Q1, right?
Exactly. It's their best revenue growth since late 2021. They grew about 15.8% in Q1, so this is a definite step up. Looks like sales momentum is really picking up.
Right. But I get the feeling there's a but coming. You mentioned it's an interesting set of results.
Well, yeah, that's where this sort of tale of two numbers comes in.
Yeah.
You look at the adjusted earnings per ADS, that's American Depositary Share, came in at $0.58, or RMB 4.115. Now, okay, that did beat expectations. Analysts were looking for around RMB 3.65, so a positive surprise there.
Okay, beat on revenue, beat on earnings. What's the catch?
The catch is that $0.58, while beating estimates, is down. Way down. It's a 49% decrease compared to the same quarter last year, almost cut in half.
Wow. Okay. So revenue soaring, profits plunging. That's the core puzzle here, isn't it? How does that happen?
That's exactly the question. The answer seems to be deliberate strategy. It really boils down to huge strategic investments they're making, especially in new business areas.
Right. Investing for the future, sacrificing profits now. So where's the money going?
A huge chunk went into marketing. Marketing expenses just,
Okay.
well, they skyrocketed. Up 127.6% compared to Q2 last year. That's RMB 27 billion, or about US $3.8 billion. Last year, it was RMB 11.9 billion.
More than double the marketing spend. Yikes.
Yeah, and they explicitly said it was mainly for promoting these new business initiatives. So they're really pushing something new, hard.
Is it just marketing?
Yeah.
Or are other costs up too?
Oh, definitely not just marketing. Fulfillment costs, think logistics, delivery, warehousing, they were also up significantly. Increased by 28.6% to RMB 22.1 billion. They say that's about upgrading their systems, investing in people, improving the user experience, building capacity.
Okay, so massive spending increases across the board.
Mm-hmm.
What did that do to their overall operations bottom line?
It pushed them into the red. They reported an operating loss of RMB 0.9 billion for the quarter. Compare that to Q2 2024 when they had an operating income of RMB 10.5 billion. So the operating margin swung from positive 3.6% last year to negative 0.2% this quarter. Basically, after covering core costs, they lost money on operations this quarter.
Negative 0.2% margin. That really shows the impact of this spending. So these new business initiatives, what are they? What's the big focus?
The main one, the one getting all the attention and seemingly absorbing a lot of this cash, is JD Food Delivery. If you look at their new businesses segment overall, revenues were up an incredible 198.8%, almost tripled year over year.
Wow. Okay. Massive growth there.
Massive growth, yes, but also massive losses. That same new businesses segment reported an operating loss of RMB 14.78 billion. That's over US $2 billion. A year ago, the loss in that segment was much smaller, around RMB 0.7 billion.
14.78 billion RMB loss, just from new businesses.
Correct. And to put that in perspective, the operating margin for that segment was negative 106.7%.
Minus 106%. What does that even mean? They're spending more than double what they make.
Pretty much. For every dollar in revenue from these new businesses, primarily food delivery, they spent over $2 to generate it. It shows you just how expensive it is to break into that market and build scale quickly.
That is a serious burn rate. They must really believe in this food delivery thing long term.
They seem to. The CEO, Sandy Zhu, talked about sustained momentum in both core retail and new businesses like food delivery. And the CFO, Ian Sushan, mentioned executing strategies at the appropriate pace for these initiatives. It sounds very deliberate.
So what's the scale of this food delivery operation now? Is it big?
It's getting there. They're talking daily order volumes over 25 million. They have over 1.5 million merchants signed up and more than 150,000 full-time delivery riders. That's a huge workforce, by the way. A big asset, but also a big cost center.
150,000 riders.
Okay.
And the idea isn't for it to be standalone, right? It feeds the main platform.
Exactly. They keep saying it's deeply rooted in the JD ecosystem. The goal is synergy, bringing more people onto the JD platform more often, using their logistics, maybe buying other things, not just a separate food app.
Okay, here's where it gets really interesting for me. Because obviously not everything is losing money. They can't afford these huge losses without something strong propping it all up. What's working well?
Right, and that's the crucial counterpoint. Their core business, JD Retail, is actually doing incredibly well. Retail revenues were up 20.6%, hitting RMB 310.1 billion, and here's the key part. Income from operations for JD Retail increased. It went up to RMB 13.9 billion from RMB 10.1 billion last year.
So the core retail business is actually more profitable than before.
Yes, its operating margin hit 4.5%. They called that a historic high across all promotion quarters. And get this, its gross margin, the profit on just the goods sold, has gone up for 13 quarters in a row.
13 straight quarters of rising gross margin. That's pretty remarkable. How are they managing that?
They're doing some smart things. During their big 618 sale, for instance, their supermarket section offered unique packaging for things like milk and liquor. Sounds small, but it helps suppliers differentiate products only available on JD, reducing price wars and boosting margins. They also have this one step ahead program for electronics, focusing on new stuff like AI glasses, smart robots. Cutting-edge tech usually has better margins.
So focusing on exclusive items and high-tech gadgets. Makes sense.
Exactly. Plus, they're expanding JD Mall, their physical stores. They have 24 now, blending online and offline. It all adds up to a very efficient, very profitable core retail engine.
Okay, so retail is the powerhouse. What about the other bits, like JD Logistics and JD Health? How are they doing?
JD Logistics, JDL, saw its revenue grow too, up 16.6%. Its operating income dipped slightly, but they're expanding like crazy internationally. They're building this global smart supply chain network, adding warehouses in the US, UK, France, Saudi Arabia. They now have over 130 overseas warehouses in 23 countries.
Expanding globally. Interesting.
Yeah, and they even launched their own delivery service, Joy Express, in Saudi Arabia. Plus, they're using more automation, like their Zilong smart warehousing system. And JD Health is doing well, positioning itself as the place to launch new and specialized medicines online in China. They've added new weight loss drugs, flu meds, things like that.
So logistics and health are solid contributors, adding to that ecosystem strength.
Definitely. They round out the picture beyond just selling goods online.
Okay, let's bring back to the overall financial health then. We have this strong core, growing logistics and health, but this huge costly bet on food delivery. How does this all shake out for their cash flow and, what investors think? The stock didn't exactly pop on these results.
Right. And this is where you see the impact of that big investment on the balance sheet and cash flow statements. Free cash flow took a big hit. For Q2, it was RMB 22 billion, down from RMB 49.5 billion a year ago. That's a pretty steep drop.
Less than half the free cash flow compared to last year.
Yeah. And if you look at the last 12 months, the TTM free cash flow, it's down even more dramatically, RMB 10.1 billion versus RMB 55.6 billion the previous year. That's a significant decrease in the cash they have left after running the business and investing. It limits flexibility.
Do they still have a lot of cash overall?
They do. They had about RMB 223 billion in cash, restricted cash, and short-term investments at the end of June, but that's down from the end of last year, showing they're burning through some cash for these initiatives.
And the stock market reaction reflects this caution, doesn't it? Despite the revenue beat.
It does. The stock was only up about 1% in pre-market trading after the announcement, and it's actually down 6% for the year so far. It even hit a 10-month low recently.
So investors are worried about the profitability drain from food delivery.
That seems to be the main concern, yeah. When will it pay off? How much more will it cost? Plus, JD hasn't really gotten that AI boost that some rivals like Alibaba with its cloud business have seen this year. Alibaba's stock is up almost 50%, partly on AI excitement. JD doesn't have that same narrative right now.
Even though they're buying back shares.
They are. They bought back US $1.5 billion in the first half of the year and have authorization for another US $3.5 billion. But, share buybacks can only do so much when the market is fundamentally worried about the cost and timeline of a major strategic shift into a tough market like food delivery.
It's easy to get caught up in billions of RMB, but let's not forget the people involved. This is a huge company.
Absolutely massive. The entire JD ecosystem employed around 900,000 people as of June 30th. That includes full-time, part-time interns, affiliates, everyone from software engineers to those 150,000 delivery riders. They spent RMB 136 billion on human resources over the last year. It's a huge societal footprint, a huge human capital investment alongside the financial one. So, pulling it all together, these Q2 results are really a snapshot of a major strategic pivot, aren't they? JD is making a conscious choice. Burn cash now, take a hit on profits, to build out this food delivery business and hopefully dominate later. All while the core retail business is surprisingly stronger and more profitable than ever, funding this gamble.
That sums it up perfectly. It's a classic invest now for future growth strategy. It's painful in the short term. You see it clearly in the earnings and free cash flow. But if they can make food delivery work, integrate it well, achieve scale and efficiency, it could be a huge win long term. Think Amazon with AWS or Netflix moving to streaming. Big initial costs, potentially huge payoff.
That's a big if.
It's always a big if with these kinds of bets. The key will be watching if that synergistic value they talk about actually happens. Does food delivery bring more loyal customers spending more across all of JD? And that brings up a question for you, listening. How do you weigh that? Revenue growth versus profit now. How much patience do you have for a company investing heavily like this?
That really is the central question for anyone watching JD. How do you balance today's returns against tomorrow's potential, especially when tomorrow costs so much today? And looking ahead, what's the one metric we should all watch to see if this food delivery bet is starting to pay off or if the burn is just getting worse? Definitely something we'll be tracking. Thanks for joining us on the deep dive. Keep digging, keep questioning.